Happy Friday from all of us here at StablePoint Partners. My name's Chris Griffith, managing partner and co-founder. Wanted to get some thoughts to you here this Friday, as we try to do every week, around the markets and what's going on and some of our thoughts here moving forward. Before I dive into that, though, I want to take a moment and just acknowledge family, friends, clients that are all impacted here by the wildfires in California. This is a big deal. Our hearts go out to all of you and our prayers for hopefully better days ahead very, very soon. This week, outside of the fires in Los Angeles, I obviously met with another solemn event, and that's the passing of President Carter. I didn't have a chance to be alive for that long while he was in power. Carter was president when I was born in the late 1970s, which brings me a little bit to my thoughts on the markets this week, which happen to be around inflation. So, President Carter presided over the highest era of inflation in our country's history. So, from 1977 to 1981, the average inflation rate in our country is just under 10%. Exact numbers are 9.9% per year on average over his 4 years at the helm. Our inflation rate right now is quite a bit lower than that, right? That was an era that brought around things like the misery index and policies like whip inflation now. However, inflation continues to hang over our economy here in 2025, much further along than we thought it would have. And the reason that I bring that up is the stubborn inflation numbers that just won't go down all the way to where we want to see them are causing some effects in the financial market. So the biggest effect that you're going to see as a result of higher inflation that I think the Federal Reserve would like to see us at this stage of the game is going to be a backup in longer term interest rates. We've talked about this a little bit on some of our other videos, but you've seen since September, the Federal Reserve cut short term interest rates by a full percentage point, 100 basis points. However, longer term rates like the 10-year US Treasury have actually gone up by an even greater magnitude, north of 1%. I think today we sit at around 4.7% on a 10-year US Treasury, up from around 3.6% back in September. This is a negative outlook in the financial markets with regard to assets like bonds, real estate, dividend paying stocks. Yield oriented asset classes are hurt when interest rates creep higher as they have. So, longer term, we do expect inflation to get under control. However, the Federal Reserve has not gotten it to where they'd wanted to see it at this point. And as we look at the data for the end of the year, it's actually very interesting. Some of the areas of the market that contributed to the greatest extent to the inflation we saw coming out of COVID, like energy, food at home, core goods, some of those are actually negative now and are bringing us much lower, creating a little bit of deflation. But we're seeing things pop up in categories that weren't even on the radar before, like auto insurance, which has gone through the roof, dining and recreation, as well as shelter. Those are the three areas that are driving inflation right now. But the good news is they're all in a much better place than they were a year ago. Things like shelter with rental increases coming up, those are starting to subside. So we do see some good news on the horizon for inflation, but that probably gives pause to the Federal Reserve, as we've talked about, from moving from an originally projected 4 rate cuts this year, probably down to 2, or as little as 0, as we've talked about in some of our latest videos and emails. So, with that in mind, we are closely watching the inflation data as it comes out, closely watching the Federal Reserve, and looking forward to that getting under control and that getting tackled in the days, the weeks, and the months ahead. Outside of that, the financial markets are off to a start for 2025 pretty much as expected. Our outlook remains cautiously optimistic, but want to make sure that clients are evenly weighted, evenly balanced. We avoid the top heavy nature of the market indexes right now. Make sure you know what you own and are investing in line with your long-term goals, not getting caught up in a lot of these short-term trends. Coming up next week, we hope to have a much longer Friday market video for you, which will be our 2025 market outlook. In lieu of doing Zoom at a certain time, we're going to record that and get it out so you can watch that at your convenience. But with that, Happy New Year. Have a fantastic 2025. Thank you for all your trust, your confidence, and advocacy. It means the world to us here at Stable Point.